Hello and welcome back to another episode of the Investor Financing Podcast. Today we have a great show. We're going to talk about mobile home parks. We're going to talk about parking lots, which I know nothing about, but it's very interesting to me because I know they're just cash machines. And I like the fact that you just own the land and it's a business and you might have to have one attendant. If not, it's electronically, gated. So that's pretty cool. So please welcome Kevin to the show. Kevin is the founder and CEO of Sunrise Capital Investors, which invests in mobile home parks, parking lots, apartments, offices, single-family homes across the U.S. Anyways, I've been listening to your podcast for many, many years. I always was intrigued with mobile home park investing. Never have done it personally, but welcome to the show. It's an honor to have you here.
Yeah, Beau, thanks for having me. I'm excited to be here.
So let's, for the last 12 years or so, you've been investing in mobile home parks, and that's exciting. But I think I'm more, when I just heard that recent podcast you talking about parking lots. What caught your attention to the parking lots? And let's just talk through like this deal that you did in maybe North Carolina recently.
Yeah. No, sure thing. I've always considered myself a contrarian investor, always looking to go where the herd isn't, just, going against the grain. That's where I've always found the most opportunity in my 20 plus years of investing. And so it's kind of ingrained in me. And that's where the story with mobile home park started, 12 or so years ago. It's just that same way. Ultimately, no one really had an interest in mobile home parks. They were really difficult to get financed, and it wasn't part of the mainstream. Like there was no one talking about it. Those that knew, and those that didn't, right? And that's what attracted us to that space. And we've done really well with the mobile home park investments. And parking, very similar. What originally piqued my interest, Beau, was an interview on my podcast that I did. Now, gosh, it's probably been more than 5 years now, maybe even 6 years, but I'm always looking for niche conversations to have on my show. And I like to bring guys on that maybe do things outside of the mainstream. So not just your typical office, retail, multifamily, industrial investors, but, some other just off the wall type stuff. And one of those off the wall guys happened to be a parking lot broker and investor. So he was one of the only few brokers throughout the country that specialized in parking assets. And then he also had his own little investment portfolio as well. And I knew nothing about that business model when I had that interview. And so it was very intriguing because, again, it just, that someone owns these parking lots and garages. Sometimes the city owns them, like that's very common, but like also there's a lot of privately owned ones. It's not a common conversation that you run into, even at these different conferences we go to. Very rarely do you ever hear of anyone talking about, well, I own parking lots or parking garages. Like it's not the norm. And so I was really intrigued about this conversation I had with this broker / investor. And after that interview, my interest was so piqued, Beau, that, I slept on it for a couple of days, couple weeks, couple months. I talked about it ad nauseum with my business partner. But, at that point in our business, we just like to stay our lane. We like to do what we're the best at and not to divert our focus. We don't like to chase shiny objects. And we know how much effort it takes to really be good at another niche, bring a new niche into the fray. And so it was one of those things that we continually talked about on a quarterly basis. It never really left our minds. And, we went to a couple of the parking conferences. There's a couple of major associations throughout the U.S. that host annual conferences, went to those, got to understand the space. And what we realized, again, what became even more intriguing to us is that it was very mom and pop. It's a very antiquated industry for the most part. There's a lot of tech companies getting involved in it now that are really assisting with the parking operations, with payment collection and payment processing. But across the board, and generally speaking, it's still a very behind the times industry and a very antiquated mom and pop industry. And what we found is that the majority outside of the municipal lots, so outside of municipal owned lots, the large majority of lots and garages in this country are still owned by mom and pops that might own one, maybe two or three. And so again, very akin to that of what, some of the benefits and fractured nature we found in mobile home parks, what made it so appealing to us, also existed in parking. And so, again, that was started, roughly 6 years ago. And, we started buying parking about 3 years ago. So it took us a couple of years of studying the asset class, understanding it. And it's really, making a decision internally with our team that this is something we were serious about. We believed in it. We knew enough. We educated ourselves that it was something that we felt was complementary to our current mobile home park portfolio and our investment strategy, that we were going to move forward and we were going to start buying parking. And it actually started with the lot that you had mentioned, North Carolina. I'd be more than happy to kind of give you a case study, 10,000 foot view of what that opportunity looked like, where we found the value add. And but yeah, that's kind of the premise and the story behind how parking came about and ultimately why we wanted to get into it.
Really cool. So like in mobile home parks, there's value add, whether like some of the homes are owned by the park and then you sell them off, and you just really want to own the pads, right?
That's right.
Home park investor.
In a perfect world, yes.
In a perfect world.
Pads.
In a perfect world, that's kind of a value add play. Then when you come into these mobile home parks, you're automating rent collections and things like that, and driving rents, and maybe adding additional pads. Now I'm really interested on this whole parking lot system. Where's the value add on the parking lots?
Yeah, there's a number of different value adds. So I'll use this North Carolina one as a good case study. This particular parking lot, it's a phenomenal location in downtown Wilmington, North Carolina, in the historic district. It's a signalized intersection, so it's right on the hard corner, and it's a small lot. It's roughly 25 spaces, and so it's small in footprint, but it's literally a block or two to all the hottest restaurants, the waterfront, and everything that the historic district there in downtown has to offer. It had been purchased, had been owned back prior to 2010 by a local developer that was going to build vertical and build a mixed-use property with some condos and some ground floor retail. Just like a lot of other people ran into challenges during the Great Recession, he did as well. And ultimately, the bank took it back. And I believe it was 2010. Another local investor came in and purchased it. Again, it's just it's an asphalt lot. That's all it's there. And it was just operating as a paid parking lot, even when the developer owned it. He had intentions of building, but he never did. Another guy came in, local investor he's a local doctor. He owned some other investments, and he bought it as a bank-owned property. I think it was back in 2011-ish, maybe 2012, and just continued running into the same. But what it didn't have is any technology associated with payment collections. It didn't have a credit card machine on site. There was no parking enforcement. I know his son would operate it here and there and collect cash. A lot of cash probably never made it in his dad's bank account. And the thing is, they were doing well. When we bought this property, its prior year NOI was, I think it was $38,000. Okay. And so they paid, I believe, right around $350,000. I'd have to look it back, but I think they paid roughly in the $350,000 range. And so they were doing well when you think about it. They were basically an unlevered 10 cap. They were making a good return on their money. A lot of it probably wasn't being reported, but anyway, they were making good cash. It was a good ATM machine for them. But what they were missing out on was anyone that had a credit card, which is me. Like, I don't carry cash at all. Like, I wouldn't park there because all I had was a credit card. I couldn't pay with a credit card. So they're missing out on those individuals. They weren't implementing dynamic pricing for, the supply demand times where there's high demand with, local functions that are going on, festivals. There's a lot of events at the waterfront there. They were just charging the same amount no matter what. And that means that you're losing out on a lot of potential revenues that you could be actually capturing. And so when we looked at it, we were like, okay, things are pretty outdated here, pretty antiquated. I knew there was an opportunity there. I just didn't know what the entirety of the upside was. And so what we do, we get tied up, and then we went and basically put out an RFP, request for proposal, for all the different local operators in the area, parking management companies, professional parking management companies that actually do this as a business, that integrate technologies, that have the data, that manage over the lots in the area. They have the data, knowing that when the peak times are, when the slow times are, what's the appropriate pricing adjustments that need to be done. And ultimately, we found the best in class who manages probably about 40% of the parking in that area, and ultimately negotiated with them to actually sign this one's a double net lease. They ended up signing a double net lease with us at $72,000 a year. It's a 5-year lease and reduced for another 5 years. We paid $695 for the lot. And so for us, that was a huge win. Again, we're basically buying it unlevered at nearly a 10 cap on our acquisition price, and it runs like clockwork. And for us, we have to do nothing. So that operator came in, they installed new equipment. It had no equipment, so they installed new equipment, pay stations. They put a wrought iron fence up around it. They've got local enforcement because they've got other lots they manage. And the funny thing, Beau, is that I've gotten to know this parking operator quite well over the years. We've become pretty good friends, and he's not required to give us what his income numbers are on that lot, right? He signed a lease with us, so He gets all the upside, whatever that might be. For us, we were happy because ultimately we were getting an unlevered 10 cap on that property. But he shared with me the year after we bought it, when he had a full calendar year, and this is, almost, pre-COVID numbers. But anyway, he shared with me what that lot did in 2022. And it generated 138, I think it was $138,000 of gross revenue in that little tiny lot. And so, again, we left a good bit on the table there, but, we walked into something that gave us an unlevered 10 cap. They're doing quite well with that parking operation there. They've got a lease in place. They're capturing all that upside. And to think that all they did was install equipment, installed or integrated dynamic pricing models based on, peak demand times, and enforced parkers so that parking wasn't getting stolen. And they were able to increase the overall revenues by roughly $100,000 from what it was when we actually took over the lot, just a couple of years back, or from when, from the old owner running the lot a couple of years back. So it's, there's a lot of lots out there just like that one. I mean, we all have parked in downtown areas where we stuck our dollar bill in those metal boxes. You have to like slide it through the slot, or where there's a physical parking attendant collecting money. Like those two things right there are telltale signs that like there's value to be had in those lots. Because parking attendants, unfortunately, it just is what it is. People are not as efficient as machines when it comes to money collection, and I'll leave it at that. Some of it just might not get reported. Some of it might end up in their pockets, what have you, but they're just not as efficient as a machine can be.
So all you pay for is property taxes, and then do you have like kind of a general liability policy that for
That's correct. We do.
So that's an extremely passive model right there.
That one's very passive. They're not all that way, but that one's incredibly passive. Absolutely. There's literally nothing that can go wrong. Very few things that can go wrong with that property, other than maybe some asphalt repair, pothole repair, things like that. So, I mean, there's very, very little that goes wrong.
Yeah, that's pretty amazing. So I live in Henderson, a suburb of Las Vegas, and we got downtown Las Vegas where Fremont Street is. And there's a lot of, I'm just thinking now, there's a lot of parking lots there that, I mean, this seems to be like an amazing kind of model, because really most of us get into investing to, create a lifestyle, whether you're going to be if you have a lot of cash, you could be a limited partner, right? And you could just get good operators, but this is a good business model I never even thought about really. But like, the more I think about it, whenever I go park at the casinos, I'm spending $20 for, parking for a couple hours.
Yeah, no, and depending on where you're buying it, like for example, downtown Wilmington, there's a lack of parking. A lot of the surface lots that once existed are now towers, condo or multifamily towers or mixed use towers, and so they've eliminated a lot of. And this is happening in a lot of cities across the country. In fact, one of the the biggest boons to our business has been a lot of the major cities. This is a continuing trend. 50 plus of the major cities across the country have completely eliminated the parking requirements that they once required for developers. So historically, if you're going to build a multifamily tower in, whatever, call it downtown Las Vegas, you would be required to put in, X number of parking spaces per 1,000 square feet. Like they just had a fairly standard model, and most cities have gone away with it. And they've allowed the developer to make the decision on how much parking they need so that they don't end up with excess parking. So what that's done is that most developers, they make more money on the condo that they're building or the multifamily unit that they're putting in. Their ROI is much higher with building more units than it is building parking that might not always get utilized. It might get utilized during some really busy times or festivals or events, but most of the time, just from the folks that might be living in that building, it's not getting 100% filled. And so they've chosen across the country to essentially, build more units and put just the minimum amount of parking that they need for their residents. And so it's creating, much more of a constrained supply, which, increases demand for folks like us that own parking in these great markets. And, at the end of the day, like, speaking to that Wilmington parking lot, it will never be worth less than what it is today as an asphalt parking lot. There's no lower value. There's no lower use of that property than what it is at present time. And so it only has upside potential. And whether that's 5 years or 10 years when it's got a higher redevelopment value, I don't know. But I can tell you that we'll make a lot of money on this cash flow uncovered land play until that point in time comes. So that's kind of the beauty of the business model.
So now that you're really, it seems like you're pretty excited How do you go about, do you have like an internal team that's like sourcing deals for you? Like you're still obviously actively looking at mobile home parks. I'm sure you've exited out a lot because people are paying premiums right now out of some of your parks. You've sold them off for profits because, it seems like the last couple of years have been crazy other than right now. It's kind of a weird time, but what do you have like an internal team that's like constantly sourcing deals for you? I mean, what does that look like?
We do. Yeah, we do. So we have an acquisitions team. I kind of head up the acquisitions team. So I've got my hand in the pot there on that side of the business. It's always what I've done for the last 20 years. And it's kind of, the foundation that we built this company on. And so what we do, I do have a team behind us. We've got a few acquisitions reps that basically are out there hunting for deals. And then we have a team behind the scenes that, works on both mobile home park and also parking. But essentially, we've got target markets that we'd like to own assets in, again, both mobile home parks and parking. And they go through and basically create a database for us of the different assets in those respective markets, the location of them, the size of them, any other notes associated with like maybe who's currently running them, maybe any the other, additional important points such as like it doesn't have any, cash payment or credit card payment options on site, who the owner is, what their home address is, what their phone numbers are, and things like that. And we just pound the phones. We call these different owners and see if they have an interest in selling their property. And we do the same thing, mobile home parks and parking. And unfortunately, if you say you want to go buy multifamily, there's hundreds of brokers out there that specialize in that space. There's hundreds of brokers that they've already obtained the data that you would need. And so you're better off most of the time just working with a broker and leveraging their expertise in the local marketplace to buy something. Well, there's not really that option, at least in the parking space, and there didn't used to be that option in the mobile home park space. The last 10 years, a lot of broker teams have kind of developed into the mobile home park space, and so there's plenty of brokers in that space now. But with parking, there's literally less than 10 brokers in the country that actually broker parking assets, and very few of them actually only specialize in parking. And so in order for us to, create deal flow, we've got to kind of do it ourselves. We've got to build the database out ourselves and do what we've always done best, which is go direct to owner. And most of the time when we do that, we can buy things for below market value and not find ourselves in a bid war with other potential buyers.
And I guess that's a pure cash flow play, right? There's not much kind of tax benefits from buying a gravel parking lot other than maybe, some of the equipment you might buy for the parking structure.
Yeah, you'd be surprised. There is, and I don't have the cost seg study on that particular surface lot that we purchased, but you got the asphalt, you've got, there's some power lines run underneath there. There's curbs. There was the fencing that was there. And so there's definitely, there's some tax benefits to a surface parking lot. You'd be surprised at what it looks like on a cost seg study. Now, not as great of tax benefits on like a parking garage, like an entire concrete structure. I'd say on average, our cost seg report on a parking structure, an entire garage, you're going to be able to probably find yourself, at least as far as bonus depreciation is concerned, about 30 cents on every dollar that's invested. Wow. You'll be able to take as a year one loss. So not nearly as high as maybe a surface lot, which is probably closer to like 50 or 60%, which is not nearly as high as a mobile home park, which we've seen some that have been, 75 to 78%, as far as 78 cents per $1 invested as a loss.
Are you considering then in the future operating the parking lots yourself, like building a team out because it's so profitable?
I don't think that's necessarily the plan, and the reason being is that what you'll find is there's a major separation of those who own parking lots and those who operate parking lots, and these different management companies across the country. Most of them, even the largest ones, like you've got local, you've got regional, and you've got national parking operators. And the majority of these groups, literally 99% of them, do not own any real estate. They focus on the management side of the business. They focus on the latest and greatest technologies to create efficiencies in the operations. And it would be its very own business, and it would be quite an undertaking to actually build that out. We'd actually have to have quite a large portfolio of parking, even justify the expense of building out that internal infrastructure. And so, with all that being said, we feel that we're better off today leveraging leveraging on the backs of those that have already built it out, knowing that we can still find opportunities that have a tremendous amount of upside, even with getting third-party operators involved and kind of passing the puck to them. So I'm not saying it will never happen. I'm just saying today, at the present time, it wouldn't be the best use of our energy or resources. That at the present time, it's the best use of our time is finding new opportunities to buy, knowing that we can buy them at a fair price, and then find a highest and best class operator to come in and manage the operation for us. So I'll give you another example of a case study. It's a fairly large. So it's the opposite of this Wilmington lot. This next one is a very large parking structure that we bought in Clearwater Beach, Florida. So kind of right in our backyard here. It's I think it's roughly 700 parking spaces. It's 7 stories. It's got some retail on the bottom floor. But on this one, the value add piece, again, every different one we kind of look at, and it's in its own light. This one was a fractured ownership. Half it was owned by the city of Clearwater. The other half was owned by a local developer that was hired to develop this project, roughly 6 years ago. And a couple of things that we saw. Number one is that the cities are always bad business owners. I mean, they make poor decisions. They were charging way below market rates. When we took it over, it was about $3 an hour parking, whereas the average on these beaches was about $6 an hour, and even higher than that with different events and festivals that take place there. And so we knew immediately that we could literally just go in and just double the rates and ultimately double the bottom line. But that wasn't all. Again, they didn't have any type of dynamic pricing instituted. And so whenever there was 4th of July event and this thing would like literally fill it to the brim, they were still charging the normal hourly rate, whereas every other parking lot on the beaches was charging $40 an hour flat rate, and they were probably turning those spaces twice a day. And so just immediate upside potential by just doing it slightly different. And so anyway, the city wasn't doing that great on their financial side. They wanted to get out of it to actually put money into another project. And the developer that we bought the other half from, their basis was really low. They'd owned it for 5 years. They were happy with it. And the problem was that they didn't want to keep it with the city still owning it because the city would not allow them to raise rates. Private developer wanted to raise the rates of the parking. They wanted to change the model. But how their partnership was formed, it didn't allow them to do that. And so they were kind of stuck. And they're like, you know what? Let's just get out of this thing. We haven't really enjoyed partnering with the city on this. And so we basically were like the knights in shining armor coming in for both of them. Here, we'll get you guys a fat check. You can get out. City, you can get your money and run and move on out. And so, we knew there was a lot of upsides. We found a local operator that managed a lot of the beach parking. And before money even went hard on this deal, we had been negotiating for a couple months with these local operators, but found one that was willing to write us a lease for a substantial amount and just take over the overall operations of the garages. It's actually a triple net lease. They handle all the repairs and maintenance. They handle everything. And with that new lease in place at closing, it was essentially like an 8.5 cap rate on a institutional grade asset and just a phenomenal location, irreplaceable location. It's an entire acre footprint, literally a block from the Gulf of Mexico, Clearwater Beach, one of the number one beaches in the country, and a block from the intercoastal. So just an irreplaceable plot of land that will be busy for many, many years to come.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. I was just thinking, when you were talking, I was thinking, okay, like once you get it tied up, do you get the operating company to do their diligence where they figure out what they can pay because they're going to figure out what events they can charge for. And really the beauty of this is that they're giving you, before you're even going hard on your earnest money, they're giving you a proposal, and it's really like, okay, well, what are we paying? What's our cost of capital? What's the return for the investors? Whatever. Right. And then what your net monthly net operating income is going to be, and there's not many variables.
Right. In a lease structure, that's correct. And I will say that that's not the only structure. In fact, I'd say that's probably one of the the less common structures that you'll find in parking operations are leases, because there's obviously risk on the lessee, the parking operator, like they're taking financial risk by guaranteeing a certain amount. And actually a lot of them got their clocks clean during COVID. Those big companies that had leases in place, I mean, they got impacted in a negative way. And so, very commonly you'll see like just management agreements where it's just a straight percentage of like gross revenues. And then sometimes you'll see a revenue share agreement where it's a management agreement and it's got like some type of hurdle in there to where if the management company, meets or exceeds these revenues, there's another kicker kind of thrown their way. And those are really good as well. The problem with either one of those is that when you're out there getting an RFP and you don't know what this lot can really do or what its potential is that, any parking operator, if they're not going to sign a lease and put their name on it, they're going to give you a quote for a management or a revenue share agreement. Some of them might just shoot for the moon for the hell of it because they just want to get the agreement. There's no guarantees from their side that they're going to be able to hit those numbers. And so you got to be careful of that. Like you got to have some local market intelligence. You got to spend some time in a local marketplace to really understand, what's possible. I mean, even going as far as I've sat in front of parking lots, literally with a clicker for a couple of days and literally just clicked to see how many cars coming in and out. I'm dead. Like it. Sometimes you just got to go old school and really figure out if you don't feel comfortable with like what maybe other operators are saying, like what the potential is here. Like how are you going to be able to? Here's what it's done historically. How are you going to be able to double that revenue? Like that just doesn't seem right to me. I hope that's the case, but like I don't believe it. Like what'd you do to determine that that's what you're going to be able to do with this lot? And so there's been times we sat out there and click. Maybe not me personally, but we've hired someone sit there and click and count cars in and out over a couple of day period of time to see, you can back into the math fairly quickly then to find out, what's the potential of the asset. So, but yeah, no, it's a very interesting business. I would say that there is also a lot of, there's a lot of shadiness in the parking industry. There's a number of operators, whether it be on a local or regional basis, that there's some sliminess in this industry still. There's certain cities where the mob is still definitely involved in the parking industry, and just things to be careful of, right? And even some markets that we would never buy parking in because, the mob in those cities is the municipalities. I mean, for example, Chicago, literally they have a 25% before any other taxes. They have a 25% parking tax that gets charged to parking lots and parking garages. So before you pay your property taxes, before you pay insurance, before you pay employees, operating expenses, any of that kind of stuff, 25% is coming off the top for them just for a parking tax. And it's gone up year over year for the last like 15, 20 years. And like, it's just like, where's the ceiling there? How do we control that risk?
Yeah, that's interesting. It's a very interesting, I never thought about the parking business. I just pay the parking, but that's like, it seems like there's a lot of opportunity, and you definitely got me excited about this whole industry. Let's kind of unpack the mobile home business now, owning parks. Just from the outside looking in, I have a lot of colleagues that are, investing in parks and stuff. It seems like, like when you were involved, there was far less competition. Today, it's now it's sexy to own mobile home parks, right? So there's a lot more competition. People are sort of overpay for parks. What direction are you going in? I mean, where you think like the hidden gems are still there for you and your group, and like where do you see, that division going with your company?
Yeah, no, it's a great question. And, obviously the mobile home park space, as you'd mentioned, 10 years ago wasn't sexy. Now it is a highly desirable asset class, lots of institutional capital in the space. It's a space that, 10 years ago was very fragmented. There's still fragmentation that exists, but it's quickly becoming consolidated with, larger professional groups such as ours, and even institutional groups like Blackstone coming in and pouring, billions of dollars into the space. And unfortunately, there's a limited supply of parks. And so you got this major supply demand imbalance where, the demand is incredibly high for investors, but the supply isn't growing. There's no new supply coming into the market. And so it makes it more difficult to find those needles in the haystack. But, as far as what we're doing as a company, I mean, we'll continue to stay in the mobile home park space. We have been sellers over the past, couple of years, for a variety of reasons. We've owned assets, in Northeast, Southeast, and Midwest. And, for example,
we've sold a portfolio that we owned in New York. We sold it during COVID, mostly because during our ownership, rent control got passed in New York, and it just limited our upside potential. We still did incredibly well with those assets, but we decided no longer do we want to operate in New York, and just life is too short to deal with all the politics involved there. And then, again, as you alluded to, just prices have been ridiculous. There's seemingly always another buyer or group of buyers out there that's willing to pay way more than what we ever would for a particular asset. And so whenever we look at our own portfolio and we have a certain internal value, what it's worth to us and what we would pay again for that park, given the opportunity, we know all the skeletons in the closet. We're operating it very efficiently. And if someone comes along and is willing to, write a check substantially higher than what we think our internal value is, and at a much higher amount than what we ever feel the value would be in the coming years, then it's up for consideration as far as the sale is concerned. Doesn't mean we're going to sell it, but it's definitely up for consideration. But on the flip side, that buying, we're always out there pounding the pavement. We've definitely bought some assets over the last couple of years. It's been highly competitive, especially during COVID. We have retail capital, and so our cost of capital is a little bit higher than that of maybe some of these institutions. And so we can't, even if it's an asset we want to buy, sometimes we just can't compete. Like, it's not possible for us to buy it to where the economics make sense for our business model. So, we're patient buyers. We've never found ourselves to be forced to buy something because we have to deploy investor capital. We'll buy when it makes sense, and we'll steer clear when it doesn't make sense. And so, I mean, we've kept that mindset. 5 years ago, up to a couple years ago, when there's a feeding frenzy, even now. And so the interesting thing is, I was just talking about this with some of our investors today, is that I've definitely noticed a slight pivot. If you compare like right now at the present time to last year at the same time, as far as deals coming on the market, and actually deals that we always put offers in, like we're always writing LOI. And very rarely, at least over the last couple of years, would we ever get considered or make it to like final and best on a deal that came out from a broker. If it was a quality asset in a good market, we'd never even make it there. Like, we're just a little too conservative. And again, there's always someone willing to pay more for that. However, in the last couple of months, we've made it to final and best rounds on a number of assets that I can guarantee we would have never made it to final and best last year. And so I don't know if that means that some buyers got kicked out of the marketplace, for maybe it's their equity dried up, or maybe the volatility of the debt markets is concerning to them and their business philosophy. Maybe they're in damage control with maybe things they were paid for. In the last couple of years, I'm not sure, but there's still opportunity out there. There's still those needles in the haystack. There's still good deals to buy, but I would say that it's few and far between, at least from our perspective. You can no longer go, which you could have 7-8 years ago. You can no longer go into just pick a market. Las Vegas. Let's pick Las Vegas. Like 7-8 years ago, I could go buy actually a really nice park, probably a 3.5-star, 4-star park in Las Vegas, and probably buy it with in-place financials, probably like a 7.5 cap, 7.5 cap. That does not that does not exist, and I don't think it'll ever exist again. And so you got to dig a little harder to actually find those needles in the haystack, but they're there, and they're available. There's still operators that don't run their parks efficiently. There's still mom and pops in the space that haven't maximized the value. They haven't brought up their rents to market, things like that. But you got to dig a little harder and work a little harder than the next to find them.
Was there the same kind of issues going on, like a lot of the multifamily syndicators that took on bridge debt, underwriting with an exit of 4% interest rate, and now they're paying 6.5% or whatever they're paying? Was there the same problem with value add parks that people were taking on bridge debt and now they're like kind of stuck?
It's hard to say, and I haven't seen any of those stress cracks yet, but that doesn't mean that they're not there. There was definitely a lot of anxious money in the market the last couple of years, just looking for a place to be deployed, and being deployed into properties that were being purchased at just crazy low cap rates, with the idea that it was, get in, whatever the business plan might be as far as the value add plan, get in, raise revenues, increase NOI, and then, either refinance out into Fannie Mae or Freddie Mac, or maybe exit out of it entirely. But I haven't seen anything as far as I don't know any immediate operators that have those stress cracks. That doesn't mean they don't exist. And I haven't seen anything as far as
national news of a few investment groups or particular assets. Like I know that in the multifamily world, like the big news is like Arbor had to take back these 5 multifamily properties in I believe it was Houston. I think there's going to be more of that stuff, just generally speaking, whether it's multifamily or mobile home parks or even just other, investment groups in general. And I don't know if that one actually sounded like it actually wasn't necessarily an asset issue more than it was asset management or a sponsorship issue, right? And so, anyway, and I'd weigh they weren't capitalized well enough. They didn't, execute their business plan according to what the plan was. There's just a lot of factors involved there. But I think over the next 12 to 18 months, I think we'll see, where there is stress, there will ultimately be cracks. Like it's inevitable, and to what extent, I'm not sure. But I think time will tell, and I think that's why just everyone keep their eyes open and be prepared. I'm not gonna say there's gonna be a flood of opportunity, but I think there will be opportunities that present themselves for strategic investors and strategic buyers such as us that are ready, that have the available capital, they have equity partners that are willing to pounce on a deal. I think they'll be out there and they'll present themselves. I'm just not sure if it will be to the extent of maybe what we experienced in post 08, 09, 10, 11 with a lot of distress in the market. So, but time will tell.
Yeah, thank you. I was going to ask you about your crystal ball, but yeah, it looks like that really like a market like San Francisco. They have all these office buildings that are vacant, and apparently there's like a big surge of loans that are recasting or coming due, and the majority of them are in office. So it'll be interesting to see how that seems to be like the asset class that's probably going to get crushed in the next 2 years. The most is office in like markets like San Francisco and things. So yeah, I don't know, because there's so many loans that are coming due. That's the problem. And banks are more conservative right now.
Well, it's that, and then also like how does that negatively impact the bank that's actually got that that loan on the books, right? Like does it take them out of the lending game for quite some time? Do they tighten their lending requirements? Do they call some of their other loans on their books due just because they need the capital back? They need to clean up their balance sheet. Like, how does it impact them? And I don't know enough about that industry to speak to like what could ultimately play out, given some of the stress that's being put on those banks from the different, just speaking to the office environment, to those different loans that we know are coming due, and we know that not magically overnight, that 40% or 50% vacancy, it's not going to get filled. If anything, it's probably going to get worse, right, over the next couple of months.
Last question. I have going back to the parking lots. I was just thinking about this being in the finance world. I never financed a parking lot, but what are you now, because you're buying, bigger, some of these are larger than the North Carolina. Are you taking like 50, 60% bank debt and then raising the rest of the capital? Is that the kind of like the perfect recipe?
Yeah, that's it. I mean, we're pretty low leverage guys. Even when more leverage was available, our LTV across our entire portfolio is probably in the 50, low 50% range. But yeah, to your point, the parking garage that we bought here, that was a $34 million acquisition, and on that one, I think we ended up at like 55% loan to value on that deal. Could have got a little bit higher, but again, just we like to keep fairly conservative. But there's other options out there. But I would say, generally speaking, banks are cautious right now, just across the board. We just got a term sheet on a Phoenix garage that we're buying. And we got multiple term sheets, and they ranged anywhere from 45% loan to value on the low end, up to 70%. But my guess is they would probably get kicked back to 65. So 45 to 65% loan to value. And a lot of that's obviously representative of the in-place cash flows, debt coverage ratios, things of that nature. But that's normally where you'll see the range for parking assets.
So do you have like a fund structure, or do you syndicate each deal separately?
Yeah, it's a great question. So we've historically always done fund structures. Our current fund is wrapping up August 31st of this year. It's SCI Growth and Income Fund 3, and that is a blend of both mobile home parks and parking. And so it's got both asset types in there. It's got a couple more deals that we're closing out before we wrap up that fund, and then ultimately open up the next fund, which will also be a blend of mobile home parks and parking.
Oh, that's cool.
We've done that now for about 6 years. We used to do deal specific syndications, and just found that at least 6 years ago, what really pushed us into the fund structure, we had a lot of more deal flow than what made sense to try to do independent, deal specific syndications. And we felt it was, offered better diversification across the board to our investors. A lot less expenses as far as legal fees are concerned with, the structure of the paperwork and all those aspects that go into a deal specific. And, you're basically doing the same thing up front. It's just you only got to do it one time with the PPM and things like that. And so it was more efficient for us. And then lastly, with the fund structure, it makes us stronger buyers. And so, most of the time we've got access to a significant amount of capital that we can quickly get access to deploy into any deal. So a lot of times we can be a cash buyer when others can't. I'm not saying that all the time, but there's been many deals that we've won over the last couple of years where we've come in and our intent is to put debt on it. It's just, we knew that if we shortened the time frame of closing and we just took it down all cash, we could always put debt on a month after. And so we'll work on debt simultaneously, knowing that it's going to get placed, but it's going to be after the closing, which ultimately puts us in the best light with the buyer because there's no financing contingencies and we're not, drawing this thing out because of the lending source. And again, it sets us above the rest. So there's some attractive nature to that as well.
Thanks. Let's talk about some of your resources. So obviously, if somebody's a accredited investor and has money and wants to talk to you, where's the best place to send them?
Yeah, so if you have an interest in our company, Sunrise Capital Investors, that's our investment arm. You can go over to investwithsunrise.com. You can download our pitch deck, download our most recent webinar, get on our mailing list for when new opportunities are coming about. But again, we do have a current offering right now that is available. You do have to be accredited. It's a Reg D 506C, but you can learn all the details and see all the assets that are in the current fund. We've got appraisals up there. We've got drone footage. We've got, investment summary, all that kind of stuff on each and every deal that's in the current fund. But you can learn everything that we offer by going to investwithsunrise.com.
And then you also have an academy to teach aspiring mobile park owners how to
we used to
park.
We used to. Yeah, we no longer offer the academy. It was a program we put together about 6 or 7 years ago, and it was a lot of fun, and we really enjoyed teaching. I used to have a mobile home park podcast. You can still download it. I recorded a couple hundred episodes, but have not recorded any new stuff on that podcast for a number of years. But still, it's all relevant information. But just found ourselves to be way too busy. Actually focusing on our core business, which is investment real estate, to offer additional resources such as coaching and things like that. But you can go to the Mobile Home Park Investing Podcast. Again, there's a few other good podcasts out there on that asset class, but you can listen to the 100+ episodes we have and learn a lot of information that might have been found in that academy.
Very good. And lastly, talk to us about the book, The Cash Flow Investor.
Yeah, no, The Cash Flow Investor. I appreciate you bringing that up. And your listeners, I'd love to give a free copy of it out. You can go to kevinbupp.com/free book, so they can go, access their own free copy if they like to read it. But it's, it's a culmination of my life story, my journey into commercial real estate, the various different asset classes that we've acquired over the last 20 years. And it's mixed, my story mixed along with the hundreds of interviews I've done of some incredibly successful folks in the commercial investment world through my Real Estate Investing for Cash Flow podcast. And the whole premise of the book is around investing for cash flow, right? There's different reasons for folks that invest. Some solely invest for tax purposes, some invest for appreciation. For us, our business model has always revolved around investing for cash flow and investing, for the reasons behind creating a lifestyle of your choosing. Whatever that lifestyle looks like, your desirable lifestyle for you and your family, it can be achieved by investing in commercial real estate and creating, reoccurring, ongoing cash flow month after month, year after year. And so the book gives strategies on how to do that. It speaks about my 5 favorite asset classes in the commercial world. We have a lot of case studies in there of deals that we've historically done. Then there's also a couple additional excerpts in there from other folks in the industry that are specialized in certain niches, such as like self-storage, multifamily, assisted living, things of that nature. So it's got a ton of information there, tons of resources, and lots of valuable content.
Very good. Well, this has been a really awesome episode. I really appreciate you giving us all the nuggets and kind of breaking down why you got into the parking business, and mobile home park business is really good. I know the viewers are going to really enjoy this episode. So thank you so much for your time.
Oh, Beau, thanks for having me. It's been a lot of fun being here.
Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.